6 months ago, if you'd have asked me if I'd consider getting a financial advisor, I'd tell you to not be daft. Why would I pay for somebody to invest for me when I could do it myself for a fraction of the cost? Well, the old me obviously didn't understand the true value that a financial advisor can add, and I didn't really consider the different areas where they can add value. Recently, we did a video which discussed some research, where Vanguard quantified the value that financial advisors can add to their clients. They identified 7 different areas of portfolio management where value can be added. If you haven't seen that video, then you should definitely check it out, as the video that you're watching now is just a follow-up to that one. Vanguard believe that with the right framework, financial advisors can add up to 3% per year for their clients. That is truly impressive. But here's the question. Can we, as amateur investors, do this ourselves without paying a fee? Or should we get advice? And more importantly, is that advice actually going to be worth the cost? On the topic of financial advice, please remember that we are not professional financial advisors. So if you want independent advice tailored to your own circumstances, then you should seek that from a professional. Now, don't get me wrong, there is a lot to consider here. So without wasting any more time, let's get into it. One day, you drive into your local shops. Life's good. Then suddenly, out of nowhere, your car breaks down. What is your thought process? Are you going to need help? And should you call a mechanic? Well, realistically, that's going to come down to a few different factors. How complex is the problem? Do you know how to fix it? Do you have the equipment to fix it? Do you even have the time to fix it? Yes, you probably could spend years studying to be a mechanic to solve the problem, but is that really going to be worth it? Most commonly, people are going to call their local garage and hand the problem over to a professional. This can sometimes be painfully expensive, but you know you're in good hands. Whilst you would likely struggle to repair your vehicle, the mechanic is going to get the job done, without any long-lasting problems, and in a fraction of a time. For us, this is exactly how people should think about paying for financial advice. You're paying for a professional to solve a problem. And yes, whilst it may be expensive, the benefits for getting a professional to do it may often outweigh the cost. To help us tackle this problem, we're going to break it down into a few different sections. First of all, we're going to go through all of the ways that you can pay for financial advice, and what you need to look out for when doing that. Then, to help us decide whether paying for financial advice is actually worth it, we're going to discuss the different factors that will determine how much value you can get from financial advice. So, when it comes to paying for financial advice, it can generally be broken down into 3 different sections. You have hourly rates, set fees for a piece of work, or ongoing fees. Different advisors will likely charge fees in different ways. So we'll run through all of the different fee types, explaining how they work and when they're most applicable. First of all, we have an hourly rate, which is fairly common and is pretty comparable to taking your car to a garage. If you have a specific request or need advice on a certain topic, financial advisors can help you out, and they'll charge you depending on how much time it takes to solve that problem. Typically, you'll get an initial meeting free of charge, where you can discuss what help you need and they can lay out what they can do to help. But for any meetings after that, you'd get charged an hourly rate. In the UK, the average rate is somewhere between £150 and £200 per hour. The next type is a set fee for a piece of work. An example of this would be if you approached a financial advisor with a request. Let's say that you've got a pension pot of £250,000 and you're about to retire, and you want to know what to do with it. The financial advisor would give you a quote of, let's say, £3,000 to give you full advice and help for your problem. Of course, the cost will vary a lot from situation to situation, and it's quite difficult to quantify what's considered to be a good price. Finally, we have ongoing fees, which is a fee structure that we're going to focus on in today's video. This is where you would receive continuous financial advice throughout the year upon your request, for a monthly or ongoing fee. This fee could be a flat fee each month, or more commonly, it could be a percentage of your assets. The ongoing fee will likely be broken down into 2 parts: the ongoing fee for the advice, and then the ongoing fee for any funds that you invest with through your advisor. For the advice part, the percentage fee generally decreases as your assets increase. You'll likely be paying more fees because you'll have more assets, of course, but the percentage decreases to compensate for this. This continual financial advice is more in line with the type of advice that Vanguard were talking about in their research paper, which we discussed last week. You can think of the advice as being permanent. You build up a relationship with your financial planner, paying them a fee every year whilst they look after all of your investing and portfolio management needs. As I've said, this is the type of advice that we're going to focus on, mainly because it's the most common, but also because it's more in line with Vanguard's research paper on the value added from financial advice. It's worth mentioning that financial advisors can no longer get paid commission by selling products to you when giving advice on pensions, investments, or retirement income products. They basically have a fiduciary duty, meaning they have to look out for the best interests of the clients, by law. Previously, some financial advisors got labelled as con artists. making money off of rich people, draining their pockets with commission. But nowadays, this rarely happens, and financial advisors can generally be trusted. Typically, the cost of a financial advisor could be between 0.3 and 1%, excluding the cost of the funds that you're invested in. So, for the sake of determining whether financial advice is actually worth it, let's say that the average ongoing fee is 0.5%. This is why paying for financial advice is intimidating at first. You're giving up 0.5% of the returns that you achieve. 0.5% is no small number, especially when you consider that the global markets have returned somewhere between 8 and 9% on average before inflation. After inflation, that return is looking more like 7%. So, out of the 7% returns that you're giving 0.5% of that to an advisor. So it better be worth it. Well, to help us determine whether it is actually worth it, let's refer back to Vanguard's research. Vanguard believe that a financial advisor can add up to 3% in value for clients. So, in the most simple terms, 3% is more than 0.5%. Way more. So, paying for financial advice should definitely be worth it. Unfortunately though, it's a bit more complicated than that. Of course, not every investor is going to earn up to 3% in added value when using a financial advisor. That's more of a best case scenario. There is asset allocation, cost-effective implementation, rebalancing, behavioral coaching, asset location, withdrawal order for portfolio spending, and then total return versus income investing. Now, of course, the amount that you can improve in each of these areas depends on your personal circumstances. In fact, for some of the modules, you may not be able to improve on them at all. Let's say you're a young investor and you have no reason to withdraw from your portfolio and spend from it. That said, we think it's important to try and really nail down on how much value you could get from financial advice. Whilst this is tough to quantify, we have a few factors that are definitely worth considering. The first of these is how much money do you actually have to invest? Now this one is fairly intuitive. If you have £100 to invest, that's generally going to be a bit more simple than if you have £1 million to invest. Not only do you have more investment options when you have £1 million, you also have to start worrying about tax, which can come in many different shapes and sizes. You'd have to seriously consider asset location to make sure that you spend as little tax as possible whilst your investments grow. Then, when it comes to retirement, you'd have to worry about optimal withdrawal orders for portfolio spending. Now, this doesn't mean that investing with £100 is a bad thing or doesn't deserve financial advice. We're just saying that it's generally more simple. This leads nicely onto the next factor, which is how complex is your portfolio. Now, of course, if you're a young investor with relatively few assets, then your portfolio is going to be easier to manage. Let's say that you rent a place, you have £1,000 invested, and you own a bicycle. That is going to be very different to a client who owns 3 houses, has 4 supercars on lease, has £1 million pension, and £4 million in investable assets. Again, this relates back to the modules that Vanguard highlights in their research paper. If you have a complex financial life, there is more room for error, or, in a sense, more room for optimization. It's relatively much more simple to look after a portfolio which has less assets, so there is less work to be done. This means that investors with a more complex portfolio can generally get more value from financial advice. It's not just assets that add complexity to financial planning though. Life events, some expected and some unexpected, can add layers of complexity that can be hard to tackle. If you're a young investor without many commitments, then your situation is generally going to be more simple to manage than an older investor who is approaching retirement and battling with a divorce. This is why people who pay for financial advice are generally older, as the older we get, the more complex the financial problems tend to become. This could definitely be worth considering when thinking about whether you actually need financial advice or not. Finally, the last factor which we'll discuss is whether or not you're actually any good at financial planning, or investing in general. It's all good us assuming that when you're young, life is simple and investing is easy, but realistically, that's just not the case. Maybe you've never read, talked, or heard about investing, and you just simply don't know what's what. If that's the case, then you would really benefit from financial advice, as you'd get a lot of value out of it. At the opposite end of the spectrum, you'd have avid investors, who are generally pretty savvy and read a lot about it. These investors probably consider a lot of the modules that Vanguard mentioned in their research paper, such as asset allocation, asset location, optimal withdrawal orders, etc. But if you are at this end of the spectrum, that's not to say that you won't benefit from financial advice. Admittedly, the value added would be much less than that of an investing rookie, but you'd still benefit from the advice of a professional. Even if you are switched on when it comes to investing, maybe you just don't want to spend your time worrying about it, and you just want to hand it over to a professional who can do it all for you. Besides, maybe as an avid investor, you'd lure yourself into the false sense of security that you're doing everything right. This is when psychological biases could come into play, and a good bit of behavioral coaching would do you some good. It's worth mentioning that even Ken French is a big fan of having a financial advisor. If you don't know, Ken French is an investing all-star. famous for his work with Nobel Prize winning Eugene Farmer on their 3 and 5-factor models. These two are literally the Snoop Dogg and Dr. Dre of investing. You'd think that this guy, who is literally an investing genius, wouldn't have to waste his money paying for financial advice. But here are his words. It's the most important check that me and my wife write. My advisor is enormously helpful in dealing with our taxes, dealing with our estate planning, dealing with what we're trying to accomplish with whatever wealth we have, helping us think about the charities we want to be involved with. It's just somebody who can act as a sounding board, clarifying the trade-offs we encounter in lots of areas of our lives. It saves us time and an enormous amount of anxiety. There are lots of questions we wouldn't even know to ask without the help from our advisor. It gives you some comfort, being able to sleep at night, knowing that there's someone else who's worried about my problems. Now look, if that's what Ken thinks, I'm not going to argue with that. So, if it's not obvious already, whether or not you should pay for financial advice is a complex question. And to be fair, we've not really given you a straight answer. So, if it helps, I'm going to talk through where I stand on the subject, just to air out my thoughts and give you my plans when it comes to financial advice. Now just remember, I am not a professional, so don't just blindly follow what I say or do, and just take it with a pinch of salt. For the next 10 years or so, whilst I save up and build my portfolio, I'm going to do it myself. I'm going to take the DIY investing approach, as I currently don't really have many assets and my financial life is pretty simple. I feel comfortable enough managing my small portfolio, and I'm fairly confident that my financial decisions will set me up pretty well. But in 10 years time, I'm hoping that the picture is going to be different, and I'm going to need help. And to be quite frank, I don't really want to have to spend a lot of time or effort, which I value more than anything, on worrying about my financial plans or investing approach. As much as I love investing and reading about it and making YouTube videos, I am a passive investor at heart. And that can definitely translate into the way that I manage my investing portfolio. I want my investing to be as set and forget as possible. And a good way to achieve that is just to hand it all over to a financial advisor who can worry about that for me. Besides, if I was to do that myself, I'd probably be more likely to succumb to some of the psychological biases that we discussed before, and I just want to remove that possibility. So I've had a look around at a few different financial advisors just to see what the market's like. And here's one that stood out. It's not a recommendation, but I just want to share it with you. The company is called Lexo, and to invest with them, you need a minimum of £25,000 of investable assets. In this bracket of £25,000 to £250,000, the annual ongoing fee is 0.5%, but that fee decreases down to 0.2% as your assets grow. I really like the company's beliefs on the whole. They believe in passive investing, efficient markets, and more importantly, factor investing. If you don't know what factor investing is, we have an entire video on it. But to summarize, it's a style of investing where you target risk factors to maximize your expected returns. No, it's not a dodgy way of trying to beat the market, it's actually implementing academic theory. Maximizing risk, maximizing returns. At the heart of factor investing is a company called Dimensional Fund Advisors. Since their inception, Dimensional have been at the forefront of implementing the most groundbreaking portfolio management techniques. Their founder, David Booth, was one of the founders of the first ever index fund. Now, to be clear, Jack Bogle was the founder of the first ever public index fund, but David Booth founded the first index fund for institutions. Anyway, I digress. Sorry, I get a bit excited sometimes. So Dimensional are an ETF and index fund provider, implementing factor investing theory to make fantastic portfolios. The only problem is that you can only access their funds through financial advisors that Dimensional hand select. They only choose the best financial advisors, who prove themselves to be working for the best interest of the clients and show a good understanding of the principles of Dimensional's investing approach. Lexo are the first and only online platform in the UK that solely offer DFA funds. Looking at their funds, they show an example of their 100% equity portfolio, which I'd be interested in investing in. The Lexo ESG 100, with a crazy 20,000 holdings, has an ongoing charge of 0.34%. So, adding back to the annual management fee of 0.5%, the total ongoing charges would be 0.84%. Now yes, I am aware that that is a lot, but hear me out. Currently, at Vanguard, I invest 100% in the FTSE Global All Cap Index Fund. Looking at the full costs and charges sheet, after accounting for transaction costs and the platform fee, I pay a total of 0.47%. Now that means that investing with Lexo is going to cost me an extra 0.37% per year. 0.37%. Now, I'm not saying that that's not significant, because it is, but I think that that value would be immense, even just from an asset allocation point of view. I'd have access to the best factor-tilted portfolios on the market, which in theory should make up the costs alone. Then we can consider the different areas of portfolio management that a financial advisor can add value. which we discussed before. The modules that I'd benefit from the most would be rebalancing, behavioural coaching, asset location, and withdrawal order for portfolio spending. All of that for an extra 0.37% from what I'm paying at Vanguard. If you ask me, that is an absolute steal. Now, as I've said, this may not be for everybody, and I'm not saying that you should go and start paying for financial advice right away. I just want to share my thoughts and where I stand on it. Ultimately, it's a tough decision that's going to vary a lot from person to person. So if you are considering it, then you should seek advice from a professional. But I guess the main point that I really want to get across is that paying for financial advice is not half as bad as what I originally thought. As I said at the beginning, if you'd have asked me a few months ago if I'd want to pay for financial advice, I'd tell you where to shove it. But now, it's something that I definitely plan to do in the future. And, as a matter of fact, I actually look forward to it. On that note, I'll see you next time. Thanks for watching.